Good evening. Thank you all for coming in here. It's a pleasure to have you on board. Lots of new members, lots of new faces, and the usual board members. Just want to say a couple of things before we start this. We're not a political organization. There aren't enough problem solvers. There are problem creators. The mandate of the Financial Policy Council is to find solutions, is to brainstorm with people who are on the inside, who know what's happening. We've targeted 3 sectors, 3 markets, 3 geographies, and we're here to attract, as a magnet, all the talent in these 3 sectors: Washington, D.C., Wall Street, and Hollywood, to bring in the best and to find solutions for the country's economic woes. This is what the Council is all about. This country needs solutions more than ever. If you support that, then you're going to be very happy here and you're going to support us. By the way, this is behind closed doors. What happens here stays here. As a speaker today, we're going to have one of the most preeminent wealth managers in the nation, Adam Frank, who's the head of global wealth management at JP Morgan. Adam is exactly the kind of speaker that we bring in on board. People who can share with you views, ideas that you don't read in the papers or anywhere else. Ladies and gentlemen, let's welcome Adam Frank.
Thank you, Ziad. That was an effusive introduction, and thank you everybody for coming. The obligatory joke that I have to tell you I found on Wikipedia. 3 guys up on a cliff, and they meet a wizard who says to them, "You're going to have to jump off the cliff, but I promise you that if you say something as you're falling, it will appear at the bottom." So one guy goes first, and as he jumps, he yells, "Pillows!" And sure enough, he falls on pillows. So the second guy jumps, and he yells, "Hay!" And sure enough, he falls on hay. And the third guy runs to the edge of the cliff, and as he's about to jump, he trips over a rock and says, "Oh, shit." Which I thought was an apt joke, which is great that it's a cliff joke and the shit joke, because that's what's going to happen, right? That's where we're ending up. There's a lot of things that are now, as a result of President Obama's re-election, more likely to happen. We're more likely to go over the fiscal cliff than we were prior to Tuesday. And you've seen it in the papers, you've seen it in the news, on TV. The headlines every day now is fiscal cliff, fiscal cliff. Why did the markets go down? It's the fiscal cliff. Now, nobody knows what that means, but everybody knows that it's because of the fiscal cliff. The fiscal cliff, as I'm sure you all know, is the combination of tax increases and spending cuts that occur automatically as a result of the budget negotiations last year if Congress doesn't act. And unfortunately, congressional inaction is the sine qua non of this Congress. It's a lot of what happens in Washington is gridlock, and the political gridlock doesn't look like it will have shifted as a result of the election. If we go over the cliff, we'll come back, right? There's not a question of, is there going to be a compromise? Is there going to be a deal? It's really a question of when it happens and what it looks like. All right, so when could it happen? It's not certain that Congress can even come up with a compromise framework to kick this can down the road for 2 months or 3 months or 6 months. It's the uncertainty that's killing us, is really hurting business, it's hurting investment, it's hurting infrastructure investment and so forth. So whatever happens, it needs to be certain for a period of time. So the things that I had planned to talk about, a discussion about how the tax increases affect us as individuals and as business owners, and as people who are being targeted by a lot of the policies that are either going into effect by default or that were in the president's budget proposal in February, which is now back on the table. It's now, I think, more likely for some of those things to become legislation. The tax increases, the top 2 rates go from what they are today to 36 and 39.6%. The dividend tax potentially goes from 15% where it is today to 39.6%. Dividends, as you recall, before 2001 were taxed at ordinary income tax rates, automatically on January 1st. It causes tremendous chaos because employers don't know what to withhold for their employees. Businesses don't know how much they're going to have to remit to the government at the end of the month or the quarter. Markets drive policy and politics, and it's not the other way around. And for those of you who remember the first vote when Congress thought they were going to be badasses and voted TARP down, the market was down 800 points. And they woke up the next morning and said, okay, we got to get this done. And a couple days later, they voted TARP in, and the market was up 1,000 points. And unfortunately, I think that's what has to happen. And I don't think the last week, where the market's down about 600 points over the course of time, is enough to do it. It needs to be a sharper contraction. There's an additional tax that was imposed by the Affordable Care Act, by Obamacare, of 3.8% on net investment income. The capital gains rate is scheduled to go from 15 to 20%. That's definitely on the table. I think it's more likely than not that that's where we end up, whether it's as a result result of going over the cliff or as a result of compromise. Dividends, even if they remain qualified to be taxed at capital gains rate, will be taxed at 23.8% from 15, and then potentially 43.4% if you include the 39.6 plus Obamacare. It's nasty. It's not fun, but that's where Congress is. That's where the law is. Gift and estate tax provisions. If we go over the fiscal cliff and the law reverts to what it was in 2001, the exemption amount goes to $1 million from 5.12, and the rate starts on the first dollar over that at 41% and increases to 55% for bequests or gifts of over $3 million. That actually goes up to 60% once you get above $10 million for the next 7-point-something million dollars to recapture the benefit of the lower brackets. So there's an opportunity this year to give away significant assets to provide for your family, to keep the money out of the reach of the U.S. government. And there were a number of high-profile deaths, Glenn Bell of Taco Bell, George Steinbrenner, a couple others, who paid no estate tax on multi-billion-dollar estates because of the luck, if you want to call it that, of their timing, their death. So death this year is excellent tax planning, but we're generally not recommending that to our clients. The risk is Congress acts before that. I can't tell you what the odds are. Ziad introduced me and said there are a lot of people in the know. I have no idea. Nobody has any idea. Anybody who tells you they know what's going on, unless they're the president or John Boehner, is lying, because it's politics. There's a lot at stake. Both sides believe there's a lot at stake if what they believe to be important doesn't go through. The idea here and what we've talked about with clients, what we're talking about tonight, is think about what you have, think about how you want to use it over the next months, years, lives, generations, and think about how you might take advantage of the window that we have in the next 6 weeks that I think is unlikely to reassert itself during our lifetimes.
Thank you very much, Adam. That was really very interesting, to say the least.